essentially, down
1.7% here, loss of
down by
37 points or so.
between
Apple
3
shares are just getting down to this
1.5%.
Yeah, that was kind of a dark time. So are we headed for a situation similar, or are we going to have a recession at all? There are certainly experts that have been debating this. But hi, my name is Austin. I have a degree in finance, and I'm going to be covering whether we're going to have a recession or not. So it's important to really understand that there's different types of recessions, and they're not all created equal. The 2008 recession, balance sheet recessions, COVID recessions, all different. And what I think is going to be causing this recession is the interest rates the Fed are putting onto the economy for their monetary policy. So let's ask yourself, what is recession? Well, Investopia defines a recession as a recession is a significant and widespread and prolonged downturn in the economic activity. And then experts will argue that it's 2/4 of the blah, 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 blah. So let me show you how the Fed could accidentally put us into a recession. So just to summarize it up and make it easy, inflation was going crazy in COVID. So the Fed has been increasing interest rates to stop inflation. And by increasing the interest rates, they could put us into a recession because the interest rates hurt the economy overall. And once the Fed can lower interest rates, we can get the economy back on track. But they're looking for these three things. They're looking for housing prices to go down, unemployment to go up, and goods to go back down. That's banana, I know. So by looking into these three different categories, we can get a little bit of an insight of what the Fed might do at the upcoming meeting. And if they drop rates, we might avoid a recession. So first up, jumping into real estate prices. In 2022, they were at the all-time high. So the Fed really wants to see these come down. According to Redfin, the average home price in May 2022 was over $430,000. And the average home price that sold the year before was $386,000, which is an 11.3 increase, and the stock market did negative 20%, meaning it was the best investment of the year. And out of all of the states on a wide scale, Florida had the biggest increases across all markets. So in order to slow prices, the Fed had increased interest rates, making mortgages at all-time high of 7%, which is the highest it's been since 2002, meaning from October 2021 to October 2022, interest rates had doubled. In October is when we saw the highest interest rates. So when interest rates go up, people are less likely to buy, and it brings demand down. But sellers around that historically low mortgage rates of around 2%, they don't want to sell either, as they're making so much money on their mortgage because they're not spending so much on interest. And if they were to pick up in a mortgage now, they'd be looking at around 7%. And this has resulted in a 35% decrease in home sales from November 2021 to November 2022. And keep in mind, this is total volume of sales. This isn't actually housing prices, but it's still an interesting indicator. So how does this affect the home prices? Well, if there's less buying and selling going on, that means the home market will move slower than all the other markets. So if we saw huge sell-offs from the stock market and CPI data was bad, the housing market's usually around 6 months behind that, just because there's less volume and less transactions happening. Forbes says there are mixed signals from economists about if and when the housing market will crash, or if it will simply correct itself from the double-digit percentage jumps seen in home prices in the past year. So I think there's a pretty easy explanation for this, as different parts of the country saw different amounts of growth, with Florida and Texas being some of the highest growth states. So these areas that saw the most growth will naturally probably see the biggest drop-offs. Places like Austin, Phoenix, and Palm Bay have already seen declines of nearly 10% since their peaks in 2022. And in a different video, we can go more in depth to see what the real estate market is doing, but I think this is exactly what the Fed is looking for in order to decrease rates, or at least they can check the mark off of their housing section. Which brings up to the next point, unemployment. And they want to see unemployment go up. So what happened in 2022? According to NPR, 2022 finished on a high note, adding 223,000 jobs in December and 4.5 million jobs the whole year. And with the 2022 unemployment rate being 3.7%, one of the best we have seen since the pandemic. So what's the big issue? It sounds like unemployment's going down. That's good for everyone. More people have jobs. Well, no, that's not the case. It's actually the opposite. The Fed wants to see employment going up or getting worse. And if they see unemployment's getting worse, they might lower the interest rate, keeping us out of a recession. You may have seen big names like Google, Amazon, and Salesforce cutting thousands and thousands of jobs across all markets, but there's not a lot of evidence this is happening widespread in the market. Yahoo Finance says how big tech layoffs are a problem of the industry's own making. Obviously, during the pandemic, people were staying home, so we used technology to connect people, and those companies did extremely well and saw high growth. Companies like Zoom, Microsoft, Apple, anyone in the tech sector saw great sales. But now demand is easing and people don't have as much money to spend on these tech products. So these tech companies, they naturally need to start cutting back on that excess growth. But other companies, didn't see as much growth during the pandemic, so they don't have as much to cut back. Even looking at the chart from Yahoo Finance here, you can see how much they added during the pandemic, but how many layoffs are actually happening right now. In fact, Chipotle said they're going to hire 15,000 people for burrito season. And Boeing says they're going to hire 10,000 more people, and they're both citing there's upcoming demand they're expecting, showing us that the tech sector may be getting hit, but the rest of the market's a little bit more resilient than we might think. And Wall Street Journal did an interesting poll showing us that companies under 250 employees keep on hiring more and more people despite the Fed raising rates, showing us small businesses just keep posting jobs because they need more and more workers. I'm sure you've seen signs hiring around your area. According to Barron's, cooling the labor market is the Fed's #1 goal. So overall, Fed wants to see decreased wages, but a byproduct of that tends to be unemployment. So really, they're kind of looking for unemployment to go up. That way they can start lowering the rates. But currently, that's the exact problem they're having. They're worried about a wage price spiral, which would be the worst part for the economy right now, which would basically make good prices go crazy. And that's exactly what the Fed wants to keep from happening. And right now, everyone's scared of the big quit, but that's an issue for a different video. And the last category the Fed is looking for decreases on good prices. I know good prices have been going crazy. I'm sure you've seen everything about egg prices nearly tripling in the last couple months. But this is what the Fed is looking for, a decrease in goods. Jerome Powell, the head of the Fed, said price stability is the bedrock of a healthy economy, but restoring price stability when inflation is high can require measures that are not popular in short term as we raise interest rates. And that is exactly what the Fed has been doing at a historical rate. Currently, their interest rates are at 4.5%. And the easiest way to measure this is looking at CPI data. It's kind of like going to the store and just measuring how much bananas cost each week, and then comparing all the data from all around the country and putting it together to get one number. It's not super easy to measure everything individually. But in December, the CPI data report released good news, well, bad news, but good news, because the overall goods prices went down by 0.1%, which is the first time it's declined since the pandemic, and the largest declines coming out of the energy sector. But we're about 2 weeks away from seeing the next CPI report, so the easiest way to measure it currently is the PPI report, which came out last week. And the consumer price report is basically you as consumers buying it from the grocery store versus producers is like the grocery store's prices. And that one was an extremely good or bad report saying prices had dropped by 0.5%, which is great news and giving the Fed a good indication of maybe it's time to drop rates. So if housing prices, unemployment's going up, and good prices are falling, are we still headed for a recession? And my answer is maybe. Like I said earlier, a recession this time would be induced by the Fed, meaning we don't have a lot of control over it. So once the Fed sees dropping in these three categories, they need to stop rate increases in order to keep us from over-tightening. And over-tightening is a nice term for saying putting us into a recession. In December, Jerome Powell said, "My colleagues and I do not want to over-tighten because cutting rates is not something we want to do," he said. That's why we're slowing down and we're going to try to find our way to what the right level is. See, the Fed is in a difficult decision right now. They are getting signs that it's time to stop rate increases, but if they stop rate increases too early, that could let inflation creep back up again, and that would start us all over at the beginning. So John Roberts, he spent 35 years on the board of the Fed. He writes in a great article, "What if inflation comes down quickly?" And he says a soft landing, which basically is avoiding the dirty recession word that I'm talking about, is possible as long as the Fed times it perfectly. If they wait too long, it's going to put us into a recession. If they do it too soon, it's going to put us into inflation. So his analysis, and after running multiple models, showed that it is definitely possible for us to avoid a recession as long as the Fed acts at the appropriate time. And if the Fed misses their small window, a recession is certainly on the table. So Powell last said that unemployment's the biggest concern, and there's new unemployment data coming out soon. So it'll be good to look at that, and that'll help us dictate which direction we go. So here's my prediction. If rates haven't stopped increasing by May, we totally may be headed for a recession. But if they have stopped increasing by May, I would say a soft landing is totally on the table and we might be able to avoid a recession completely. But if not, I basically think it's going to be a mild one. So I am no financial advisor. I just have a degree. Let me know your thoughts of what you think might be happening, and I will catch you on the next one. It would be a big help if you subscribe and like the thing, but see ya.